Today, we're breaking down 5 essential questions that you need to ask your lender, asking what options you have when it comes to rates and points. Let's talk about why APR is probably the most misunderstood thing when it comes to a rate.
One of the very important outcomes that you need to have of this initial conversation with a lender is, which programs am I eligible for? Okay, which one is most likely best for me? Now can we see them on paper, including max qualification, monthly payment, and total cash to close?
This is The Educated Homebuyer with Jeb Smith and Josh Lewis.
Buying a home is one of the largest financial transactions you'll ever have in your life. And if you don't ask the right questions, you could end up paying thousands more than you need to. Today, we're breaking down 5 essential questions that you need to ask your lender before you sign anything.
Absolutely. And this is really, the conversation today is a roadmap to enable you to have a consultation versus a sales call. Despite our best of intentions and letting you guys know that we are available to help in about 25 states, we have vetted professionals in all of the other 25 to help you. We get calls from people all the time. I'm working with this loan officer and it went off the rails here. I'm working with this loan officer and they said it didn't go this way. I called the giant national call center and they didn't give me this information. So we have an easy button for this. You can reach out directly to us. But what we want to do today is give you a roadmap of, if you ask these 5 questions, they are leading questions. They're open-ended questions that should get a discussion that encompasses everything that you want and need to know within the scope of your pre-approval interview. So with that, Jeb, you're saying before you sign anything, this is really before you do anything. You know what I'm saying? Mm-hmm. Like an interesting point, and I have friends that are really good loan officers that do a lot of business and do a good job for those clients. Not just they do a volume, they do it well. And they start the process by saying, hey, here's my online loan application, complete that, and then I'll schedule a call. Like, okay, the online loan application includes my social, date of birth, where I've lived for the last 2 years, like some pretty important things that I don't know you. I haven't talked to you. Mm-hmm. I'm not giving you anything. So when we say before you sign anything, I say before you do anything, have a conversation. And this conversation is going to be the roadmap and set the tone for your relationship and with your lender and your loan officer, and for that transaction of how it's going to go from the loan side. I cannot overstate this enough. That first call is critical for you to know that this person knows what they're talking about, hears you, asks good questions, but it's important for me to get a feel for you. What do you want? What are your goals? What's your current situation? What am I going to need from you to make that happen? So literally, this first call and these 5 questions, the importance of them cannot be overstated.
Gotcha. So a lot of people find us online and then they end up calling because they watch a video on a different type of loan program. And then they come into the conversation thinking that they know what is best for them. So the first question we want to talk about today, Josh, is rather than coming into the conversation thinking, hey, I know it all already and this is what I want, it's rather a question of asking, what loan programs do I qualify for? And then looking at those loan programs to determine which program is best. So Josh, let's go into a little bit deeper of that question. So when the question comes to you, or I guess better yet, what is the question they should be asking when asking about loan programs?
Instead of, like you said, we get a lot of people reach out. They'll have seen, Jeb, you've done several really high performing videos on FHA loans. So I'll get people to call, hey, I want an FHA loan. Okay, if you walk into your doctor's office, you say, I want some Prozac, they just don't go, hey, let me get my script pad and hand it over to you. They go, well, tell me, what issues are you having? Mm-hmm. That's what your loan officer should be doing. I say, well, cool, that's awesome that you watched that video. You obviously saw some things in there that tell you that FHA may meet your needs, but let's go through a few things. So you can ask them, what programs am I eligible for? They can ask you questions to start narrowing down the field. So let's look at it. Probably 95% of loans in the United States of America either go to Fannie Freddie guidelines, Fannie Mae or Freddie Mac, FHA, VA, or USDA. And VA and USDA, most people aren't eligible for. Are you buying a home in a rural area and do you meet the income limits? No? Okay, let's scratch that one off the list. Are you a veteran? No, you're not a veteran. Let's scratch that one off the list. So we're really talking FHA versus conventional. And I had a guy literally called this week, had watched one of your videos, and he says, hey, I'm looking at this and I'm just really confused. I don't know if I should do FHA or I should do conventional. Okay, tell me a couple things. What your credit score looks like? He goes, it's at least 740. It varies over time. Usually it's above 760, 780. I said, okay. Still, some folks with great credit will look and decide that FHA is the better option. But as we dig into it, he's going to put 20% down. So in that situation, makes no sense in the world. FHA loan will have an upfront mortgage insurance premium, monthly mortgage insurance. You're going to get great terms with that credit score. So that's what that conversation is looking like. He is eligible for FHA, but conventional is the better reason and the better route to go. And where we go is first we narrow it down to what are the programs that you are eligible for, then which best fit your needs. Like in that situation, he may be eligible for a down payment assistance program, but there's no free money. Those generally come with a downside. So he's probably going to eliminate those also. But what is the most important thing is that second question. Okay, awesome. So you've narrowed it down. I've got 2-3 loan programs that I'm eligible for. What's best? What's optimal for me? And beauty is in the eye of the beholder. That is a decision for you to make. Not for your loan officer, not for Josh, not for anyone else that you're talking to. That is for you to make. And the only way we can help you make that educated decision is to do a side-by-side comparison. Another podcast listener, Jeb, we're helping down in the San Diego area now. And we're going through the process and kind of sent him FHA and conventional. And he looks at it and he goes, well, these are the numbers I got from another lender. They didn't even send me FHA. They said, I wouldn't want to do that because you have to do an upfront mortgage insurance premium. And I looked at it and I go, okay, well, I mean, that's them making the decision for you. Let's look at what I sent you. And we go through it. And it was one of those where literally 50-50. Half of people will look at it and go, I want to go FHA. Half of it will look at it and go, I want to go conventional. There's pros and cons to each. The only way that we can do that is to get you a side-by-side comparison. So if we're initially at this first conversation, you're asking these interview questions before you decide if you even want to move forward, you're not going to get that side-by-side comparison. But I can verbally give you that. It's not going to mean half as much as that side-by-side comparison where you can see those differences, where you can see the difference in cash to close, the difference in the monthly payment, where the additional funds go, why you end up with a larger loan balance with a 3.5% down FHA versus a 3% conventional, or why 3% conventional is a little bit higher payment than 5% based off of mortgage insurance and the difference in the loan amount. You need to see those things. So hopefully in this initial conversation, the loan officer is telling you, okay, cool. I've got a pretty firm handle on what you're eligible for, what should be best for you, but I'm going to show you a comparison so you can see why I think that and make sure that you agree and we're doing what you want in terms of that loan.
Yeah. I mean, you recently said that there's a lot of people out there right now, not being asked what they want, but rather being told what they're going to get. So not giving them the option of FHA. And sometimes it might not be the right option, but hey, let me decide on that. And I'll take it a step further, Josh, and say that, you know, I hear you oftentimes on the phone, somebody has 10% down and you say, yeah, you can put 10% down, but maybe you do 5% down and this is your option at 5% and this is your option at 10 or whatever. And then you use that additional money, pay off some debt. And now you have an overall lower payment. Yeah, maybe your mortgage payment's a little bit higher, but your overall debt load is lower. And it's just about having those options. Without knowing that and just being told what you get, then there's no room for comparison. But taking that into our second question, Josh, and that's about asking what options you have when it comes to rates and points, right? A lot of people get quoted a rate, or a lot of people call and say, hey, Josh, what is your lowest rate? Or whatever that question looks like. Versus asking the right question about, hey, what are my options when it comes to rates? What are my options when it comes to points? So let's dive into that a little bit deep.
This one of the most frustrating and infuriating things as a loan officer is we have this great front end conversation, spend 30, 40 minutes with the borrower. We narrow it down. We send them over a comparison of a couple of options and they call me back or I call them back and follow up and say, hey, what did you think? We're going, well, I really like those options. You had a great call. You gave me a lot of information. Talk to another lender. They're giving me a better loan. Cool. Tell me what the better loan is. Well, it's a lot lower interest rate. Okay, cool. I know no one has a lot lower interest rate than what we have. So we know something's rotten in Denmark right there. If you tell me someone's 1/8% lower, It could happen. If you're telling someone's a lot lower, we got a problem. And we're seeing this a lot with the heavy refinance market right now. Call center loan officers, you call Rocket, you're a veteran, you call Veterans United, they're going to send you a loan estimate with $10, $15, $20,000 of points in box A because they want to have a really, really good interest rate. So that's the part that we want to talk about here. On any given day, if we say rates right now on conventional loans are plus or minus 6%, well, the rate sheet goes all the way up to 8 and all the way down to about 4. I can offer you a 4% interest rate. You're probably not going to want to pay $40,000 in points to get it. I can offer you an 8% interest rate. The pricing's probably not any better than 7%. And what that does would get you a big lender credit to cover your closing costs. So on any given day, we have to talk about that. What are your needs? Do you need a lender credit? And it's been a tough market for that. We've done conversations on the show here before about should you pay points or not. Go back and listen to that if you're considering it. It is a tough market to get a lender credit. Normally, if we go up a 0.25% in interest rate, you would get 1% of your loan amount. So $500,000 loan, here's $5,000 for you taking a quarter higher rate. In general, in the current market, we're having to go up much higher than that to get that. So most people aren't doing it. The question becomes, do I want to do 0 points or do I want to pay points? And especially when rates were up at 7.75%, 8%, people were going, I can't afford that. I got to look at this. I got to pay. What if I pay 2 points? And you look at it and you go, okay, we are at a near-term peak in interest rates, or what we believe to be a near-term peak. Jeb doesn't have a crystal ball. Josh doesn't have a crystal ball, but we believe rates will recede from here. So you are paying to get the rate that in 6-12 months you would be able to get for free, which is what we are seeing right now with the wave of people that bought in the last 2 years with last 2 months dip in interest rates reaching out and refinancing. So it's a valid decision, but it's your decision. Someone shouldn't just tell you, hey, here's my rate. It's 5.625. And you're like, okay, that's an awesome rate. I like that. But you don't look and see that in box A, there's 2.25 points. And on your $500,000 loan, that's $12,500. Most importantly, in the context of this show, The Educated Homebuyer, the vast majority of people that reach out are buying their first home. And most people that are buying their first home don't have a giant chunk of cash. I deal with a lot of veterans. Most veterans, 90% plus, do 0 down. If you do 0 down, if you're putting no money down, you have no money for a down payment, do you think you have 1.5% or 2% to put towards buying the interest rate down? No, I can tell you the answer is no. They don't have it and they don't want to pay that. Yet the biggest call center lender in America that does VA loans, that is the only way they price them. So if you call, again, we'll just call them out by name because this is a fact. You can test me on this. Call Rocket, call Veterans United, get a quote. They're not going to tell you what it costs. They're not going to give you a loan estimate, but they're going to give you an awesome rate, or at least a rate that is good in the market. You're like, oh, that's cool. Then you get a property under contract. You and Jeb go out, get an offer accepted, send it over, and they go, okay, here you go. And there's 1.5, 1.75, 1.25 points in there.
So Josh, let's take that a step further. Let's talk about 2 things. One, what to pay attention to when getting those quotes of interest rates. We've talked about it several times, but let's do a short version of it for the show today and talking about the question. But more importantly, I want to talk about APR. A lot of people call and say, hey, I got quoted this APR. Let's talk about why APR is probably the most misunderstood thing when it comes to a rate in general, right? Because people think that what they're quoting rather is an interest rate, and they say APR. They get the term confused, but rather, I guess let's just talk about why it makes absolutely no sense and why you really shouldn't pay attention to it. And by paying attention to the loan estimate, it makes more sense. A little bit easier to understand.
Try and explain what it is. So I know most of you are not getting a $100,000 loan, but assume you're getting a $100,000 loan and there was $5,000 of costs, prepaid finance charges. So here's part 1 of the problem with this is prepaid finance charges. If you look the way it's written in the law, it's this big, long, hairy list, and not everyone agrees on what should fall under a prepaid finance charge. And when you have an issue of I'm comparing a conventional loan to an FHA loan, on FHA, your 1.75% upfront mortgage insurance premium is considered a prepaid finance charge. So if we're comparing those two, the APR is going to go through the roof on a VA or an FHA loan that has a funding fee or an upfront mortgage insurance premium. But what they're doing is, okay, here's $100,000 at 6% interest. Here's what the payment is. well, what you care about is my interest rate is 6%, and that's what my payment is. The government said, we're going to help people compare. We're going to say, well, there was $5,000 of costs. You're only getting loaned $95,000. So if you got a $95,000 loan and that was your monthly payment, what would be the equivalent interest rate? And it goes up. So the thought there is the more you're paying for the loan, the higher that APR goes. So now you can call 5 lenders and say, what's my APR? And you don't have to dig down into this. But like I said, most people don't calculate it correctly. Most people don't quote it up front. Most times you don't see it until it gets to a loan estimate. So we've talked a million times here on the show. What do you need to know? You need to know, what interest rate are you offering me? What are my Box A charges? Box A charges are not just points. It's also processing, underwriting, anything. And every lender is going to quote that differently. And I don't care. It doesn't matter. It is irrelevant. Don't get bogged down. Don't care about what they're listing. If they have 1 line item, 50 line items. What is my total Box A charges for that interest rate? And that now tells you, if I'm comparing 3 different lenders with conventional loans, this is the best interest rate at the lowest Box A cost versus, hey, I got this great deal because I got the low interest rate, but oh, geez, they're looking for me to pay $9,000 in Box A, and I don't have it because I'm doing a 3% down purchase.
No, exactly. And I often hear people reaching out and saying, hey, this is the rate that I'm being charged, or this is the rate I'm being given rather. And I'm like, okay, so what are you paying for that rate? I don't know. I didn't get a loan estimate, or I don't know. They didn't really go over that. Make sure if you ask the right questions here, they have to answer them, right? Or they deflect and move on. And if they do that, then you know what you're dealing with, right? If you're asking the right questions rather than being told what you're going to get, then you're going to get an answer, or you're not going to get an answer. And then by not getting the answer, you're getting the answer.
And Jeff, the topic of this show is 5 questions that you need to ask your loan officer. But a question the loan officer in this needs to tell you, or at least tell you where they're starting from. Yes. When I send you the initial comparison of 1, which isn't a comparison, it is, hey, here's your one and only option, 1 to 3 options. We always start with 0 points so that when we're looking at those 3 options, if we do an FHA, a 3% down and a 5% down conventional, I want you to have as few variables to consider as possible. They're all coming across at 0 points. But if you go, hey, Josh, don't show me 0 points. I want to pay a point, or I want the best interest rate, or what does it take to get to this rate? Okay, you're calling the shots. And I am happy to do that for you. But I'm going to tell you every time before I send those numbers, listen, I'm sending you 0 point numbers. 95% of my clients will do 0 points. If you want to go different, and once we decide which of these programs is right for you, if we want to look at 3 options of a FHA with 0 points, with 1 point, with 2 points, happy to do that. And now we can figure out if that makes any sense for you. But if you have a conversation with a loan officer, they send you over one set of numbers, and that number includes a great rate with you paying a bunch of Box A fees, and they never asked if you had it or you wanted to pay it, you can tell you are dealing with a salesperson and not a consultant that is interested in helping you improve your finances through homeownership.
Good stuff. So let's go on to question number 3. One of the questions that often comes up when people just reach out to me, hey, how much is this loan going to cost me? How much money do I need out of pocket? Whatever variation of that question is, Josh, how much are closing costs? How much are, combined? What am I going to need to bring in? Right. And I can tell you how often I talk to people and say, hey, how much are you putting down? Like, what did you get approved at? And they're like, I'm not even sure. We talked to, but I don't know. Well, if you don't know that, then you don't even know how much you're bringing in at the end of the day. And so let's break down, Josh, how we determine cost, what's involved. How do you ask the right questions?
So the easy one that all borrowers pretty much know before they call me, they say, we're going to do either 3% down conventional or 3.5% down FHA. It's all we got. I say, okay, well, it's all you got. I mean, how much total do you have to work with? So we have 2 questions. Oftentimes the way I ask it in that initial conversation with the borrower is, all right, Jeb, how much money do you have to work with? And there's a reason why we ask it that way. Because let's say you say $50,000, and I know we're looking at a $500,000 purchase. Some people will go, oh, cool, we can do 10% down, and they'll start quoting you 10% down. Well, if we only have $50,000, we have your down payment, and we have to cover closing costs and prepaids out of that unless we're getting a lender credit, a seller credit, covering it some other way. So I want to know what is the majority or what is the total of the funds that you have available. So in that situation, if you got $50,000, say, okay, 50,000 is total. So that's 10%, but we can't do 10% down because out of that 50, we need to pay your closing costs and prepaids. Is that correct? Oh, yeah, that's correct. 50 is all I got. Okay, well, cool. Now we're going to back into that and say, in your state, what does that look like? Like if you're in Pennsylvania, there's some pretty heavy transfer taxes that the buyers pay. We got to factor that in. So we have first party charges to the bank, lender, broker. We have third party charges that you can't shop for, your credit report, your appraisal, all that stuff. We have things like escrow, title. Then we get into the government charges, recording, taxes. Those are closing costs. If you don't buy a house, you're not going to pay them. Or if you don't finance the house, you're not going to pay them. We then also have to account for what we call prepaids. And even if you do not want impounds, you're putting 20% down, you're not impounding for your taxes and insurance. The lender is going to want you to pay the first year's homeowner's insurance premium. And when you close, say on the 15th of the month, they don't want a half payment on the first of the following month. So we all know that you don't make a payment on the first of the month, but you still owe interest for the days that you had the lender's money. So they would collect 15 days of interest. And if you close on the 25th, they're going to collect 5. If you close on the 5th, they're going to collect 25. So you're at a minimum, you have your first year's homeowner's insurance premium, and you're going to have 5, 10, 15, 20 days of prepaid interest. If you are with an FHA loan and you have to have impounds, or if you prefer to have impounds to escrow your taxes and insurance, then depending on where you're at in the country and what time of the year we are in, we have to run a calculation and say, here's how much has to be collected at closing. So when you make X number of payments before those taxes are due and the insurance renewal is due, that we have enough in there. So like, it shocks me how infrequently someone who has talked to another lender has any idea what those numbers look like. And again, on this first call, Jeb, we're not going to go into that. And what I tell people is, don't feel bad that you don't have a ton of questions or you don't feel like you have really insightful or in-depth questions on this first call, because once we give you that comparison, we're going to open up a ton of questions. You're going to look at interest rate. You're going to look at down payment. You're going to look at closing costs. You're going to finally see what prepaids are. If we close in California in December, you're going to go, oh, okay, I see what those prepaids are. You're going to see all that, and you're going to have a lot better questions. But one of the very important outcomes that you need to have of this initial conversation with a lender is, which programs am I eligible for? Okay, which one is most likely best for me? Now can we see them on paper, including max qualification, monthly payment, and total cash to close, to make sure that you are prepared and have that, and that we don't have stress throughout the process of going, oh my God, that's $5,000 more than I thought, and I don't have that or a means of accessing it.
No, good stuff. And so, you brought up an important point there. Like the questions that we're talking about today, some of them you're not going to get 100% of the answers to on the very first call. I think we should be clear about that. It's about asking the right questions. And then with those questions, again, you're going to get the answer. So the next one we're going to talk about here, Josh, is the loan estimate, how you actually see what fees you're being charged, what rate is being proposed, monthly payment, all of the things that kind of go along with that conversation. Chances are on day one, you're not getting a loan estimate, right? Because it's initial conversation to figure out, hey, do I even want to move forward with Josh? Do I want to do a loan application? Is Josh the right lender for me? And if that's the answer, then you're doing some of the paperwork, some of the things that go along with it, which we're going to talk about here in just a moment. And from there, you're going to get some of these additional questions. But you can ask them on the first call. You'll get an answer. You might not get the document, but let's talk about that, Josh. So when comparing lender A or lender B, or not even comparing, just verifying what you've told me is accurate, what document am I looking at?
So easy question, right? The simple question you just asked, and it's a semi-complex answer. I can tell you what is wrong, what you get that is potentially wrong. Just closed, a buddy of mine referred his friend over to me that he had referred to the realtor, and that realtor had referred him to her lender. I'm like, I don't know why you didn't refer the realtor and the lender at the same time. But Craig calls me. He's got some questions, and he's like, this doesn't make sense to me, and the guy's not giving me straight answers. I said, cool. Okay, what are the numbers he's doing for you? And he sends it over, And it literally is like a little box that you could tell was snipped from Excel that showed that's his loan amount, that's his interest rate, that's his payment. And I'm like, you realize that's worthless. He just literally just gave you something worthless. And looking at it, I'm like, the terms aren't wrong, but you just told me the guy's not answering your questions. And you asked a question, what's this going to cost me? And he sends over what the monthly payment is. That's worthless. So we get variations of that all the time. I have a borrower right now that we just opened escrow for yesterday that went to big major national bank that you see on every street corner and basically got the same thing. Here's what it is. Here's your payment. It's FHA. This is the payment. You're going to have about this much money to do at closing. They didn't know anything. They knew absolutely nothing. So a loan estimate is a good tool because it is consistent. We know what should be on there, how it's done right. Doesn't mean that someone is doing it right. They can give you a loan estimate that's incomplete or inaccurate. But if you go to 3 different lenders and they all give you an accurate, complete loan estimate, you have a basis for comparison. But it is important to note, again, here on the Educated Homebuyer, we get a certain type of person that listens, someone that wants to be educated, seeks out information, and because of that, they have a pretty good idea. So many of you know that within 3 days of completing an application, we are required to give you a loan estimate. Well, what most people don't know is what is an application. An application has to have 6 pieces of information. One of those is an address. If we're talking about a purchase, we don't have an address. You haven't found a home yet. A loan amount. We just talked about we could do 3%, 5%, 3.5% FHA. We don't know what the loan amount is. We know you. We know your FICO score, all of the other elements there. So we're not required to give you a loan estimate. But what the law requires and what we as professionals should do to give you the best advice are 2 different things. So I have a custom Excel spreadsheet that I have put together that is 2 pages. It's going to show you up to 3 options. It's going to show you the principal, interest, taxes, insurance with each of those options. And it's going to give you a breakdown. It's going to show you this is the down payment. This is the closing costs. This is the prepaids. Here's the total cash to close. And then page 2 shows you where all of that money goes. So is it a loan estimate? No. Does it have all of the information on there that you need? Going back earlier in our conversation, we said, you need to know what's the loan program, what's the interest rate, and what are my box A fees for that? You have all of that in what I'm showing you. And I'm not saying my way is the only way. Most major...
It's your way or the highway, Josh.
It's my way or the highway. Most major loan origination softwares have a comparison tool, a fee worksheet or a comparison tool in there that will do something very similar. If your loan officer is giving you that up front and it is complete and accurate, that is as good as a loan estimate. Most of them will not break out and say, these are box A charges. So you may need to ask, okay, cool. You've given me 2 options here. I've got 3% conventional, 3.5 FHA. Can you just tell me on this fee worksheet that you've given me, what are the box A charges? So now you know interest rate, you know box A charges, you know what program. You can do a good comparison with that. And don't ever feel that someone that is giving you those numbers, valid, accurate, complete numbers, because they're not giving you a loan estimate, they're hiding something. The loan estimate is required at a certain point, and it is a good tool because a loan estimate is a loan estimate is a loan estimate, whereas these fee worksheets can all vary a little bit. But the most important part is that you're knowing what's the loan program, what's the interest rate, what's my box A fees, and what's my total cash to close.
Now, we have 2 things written in our notes, Josh, that I want to read. It says that it allows you to budget accurately and compare offers. So first and foremost, that's why you need this. Second thing is it helps you avoid unexpected costs at closing, because basically no one wants a surprise popping up last minute. And we hear it all the time. I didn't know I was paying points. I didn't know I was paying to buy down my rate. Well, it's because you're not paying attention to the right things, or maybe you didn't get the right information. It wasn't provided to you. I can't tell you how many times people reach out and are surprised by the outcome. It's like, what is the loan officer doing? And I'll be honest, the Educated Homebuyer podcast exists because there is a lack of education out there in the market when it comes to buying, selling, real estate, mortgages, everything. That's why this channel is here, is so that you can get the right information. So just make sure when you're going through it, you're having the right conversations, because again, it's easy to get derailed. It's easy to get emotional, get caught up in the process and forget some of the basics, and then have those surprises at the end of the day. So Josh, that's going to take us into the loan application, which is going to be the last thing that we talk about today. What documentation do you need from me if I'm applying to to buy a house, to refinance? What's that look like?
So the whole conversation today is, what should you be asking your loan officer? If I've done my job well, you probably haven't noticed, but I've asked 5, 7, 10 important questions while we're going through that, in terms of answering your questions, of listening to you and making notes. And I'm going to have a pretty solid idea. Say, okay, it's a husband and wife, and they both work. Neither of them are self-employed. They don't own any other real estate. We've got a gift coming. So with that, I've got a pretty solid idea. We're going FHA, so we need 2 years of documentation. We're not going to get away with 1 year, or we're likely to go conventional. It's going to be 1 year. So it is going to vary from borrower to borrower. The loan officer should have asked some specific questions, should have listened to you very well in this front end conversation, so that they can tell you what exactly is going to be needed. So it's going to be 1 to 2 years of income documentation. So what is income documentation? Pay stubs and W-2s at a minimum, unless you're self-employed and you don't issue yourself pay stubs and W-2s. If you are self-employed, at least 1 year, probably 2 years of tax returns, both personal and business returns, if it's an S Corp or an LLC. If we own any other property, we're going to have to show some documentation there. At a minimum, the mortgage statement. If it doesn't include the taxes and insurance, I can pull a property profile to get the taxes. You're going to have to provide me the insurance so that the underwriter can see all of those things. There are going to be 50 other little items on there. If you're divorced and you pay or receive alimony or child support, we're going to have to document that stuff. But for the most part, what are we looking at? For most people, it is a list of about 4 items. I send out a request. Hey, number 1, need you to complete the online loan application, because you haven't done that yet, because we just had our initial conversation. From there, I'm going to need income documentation, which is generally, like we said, pay stubs and W-2s. I'm going to need asset documentation. And you might say, I've got $4 in the bank. It's all coming from a gift. Cool. Just need to know who the gift donor is, their relationship to you, and when they're going to give you the money. So income, assets. We're going to need photo ID. Is it essential that we have it up front? No, but for the Patriot Act and other reasons, we're going to need it. So we might as well just front load everything. If we do this right, once you get out with your realtor and you get a property under contract, you're like, really? That's all there is to it? That's all there is to it. We just send out the disclosures that now match your exact transaction. We go through it, make sure everything matches up to what you told me you want and what we agreed to. You sign that, and we're off to the races. So basically, income and asset docs, photo ID, a loan application, and there may be some additional requests for those of you who have different situations.
Yeah, and what I'll say is, a lot of people over the years, I hear people complaining about documents that are requested for one reason or another. Maybe it's not in the initial conversation, maybe it's a little bit later down the road. And what I will say is, from somebody on the outside looking in, Josh doesn't want any paperwork that he doesn't have to have, right? If it needs to be there to tell part of the story, because you changed jobs, because you have some deposits in your account and we need to know why, or whatever it is, that's why we're asking, or that's why Josh is asking. So it's easy to get, emotional and dislike what some of the questions are sometimes, or some of the things you have to provide, but understand it's there because it's needed in many cases. And if it's not needed, it's there just in case it comes up. And, just want to be clear on that, because, I do hear people saying, well, why are you asking for this? This person didn't ask for this. Well, maybe that person didn't ask for it because they don't know how to do their job, right? And Josh is just being a little bit more diligent and detailed in that. But what I will say is, if you're in the process, you're looking to refinance, you're looking to buy a house, you're looking, don't know where to start, reach out to us. theeducatedhomebuyer.com/expert. theeducatedhomebuyer.com/expert. That will get you in touch with Josh, the team here, and we can guide you through the process. Josh can, basically do everything that we've talked about today, and help guide you through that process. So we would love the opportunity to help, and be that person for you, where you don't have to ask the questions. We're asking you the right questions, so you're getting the right information. So with that said, Josh, where should we leave listeners, viewers today watching the podcast?
If you go through that list of 5 questions and you get thorough and accurate answers, you're going to have a pretty good handle. Do I want to move forward? Do I want to give this person a complete loan application and all of my supporting documentation? And if you do, that conversation should have led to a pretty accurate request, pretty simple and straightforward collection of the data, and short-term, rather quick confirmation that, yes, you do qualify for this. And just the way that the loan officer reacts and handles that conversation is going to tell you a lot about what you can expect later on in the process. This may sound shocking. Talked to a listener in Ohio last night, and she says, we did a construction loan last year. It's at 7.25. We're trying to refinance. We like our loan officer. He's very personable, but I'm just going to be honest with you. He's really sloppy. If you notice that someone's sloppy through the process, I don't care how much you like them, you're not going to enjoy that process. I get calls like Craig said, hey, the guy seems fine and he told me I'm approved, but like I ask questions and I get a little 2-second answer. I don't want to have a bunch of 30-minute phone calls throughout the day, but however long the phone call takes to get you the answers that you want so that you're comfortable, that you understand and you know what's coming next, this is one of, if not the biggest financial decisions you're going to make in your life. I owe it to you. Your loan officer owes it to you to listen, to hear, and give you accurate information and carve out the time. And Jeb, you watch every day. It has been frustrating. Over the last month, we have an influx of loans with all of the refinance activity above and beyond our capacity. So I'm here more than I want to be all day, every day. I'm making more calls. I'm handling more stuff. But every one of those calls, you just got to remind yourself as a loan officer, if you were in their shoes and you didn't do this all day, every day, might you have that question? Wouldn't you want to know the right answer? And you get on the phone and you answer it. So if someone's short with you, they take 2 days to get back to you, they don't get you answers on stuff, feel free to move on. There's a lot that goes into this. This somewhat idiot proofs the process if you ask these 5 questions, because a bad loan officer will self-select out. They're either going to go through this short and quick, not want to answer the questions, answer evasively, but don't go and, hey, I talked to this person, I liked them, so I'm going to move forward. That's probably the commonality of the people that call us late in the process. I like my loan officer, but they're not very good at their job. I like my loan officer, but it's not enough to like them. Liking them is important. It's an element that you need to consider there because you're going to talk to them a lot, but they need to be able to answer your questions and have the time for you and structure this properly.
So if you found any value in today's episode, do us a favor, hit that thumbs up. If you're not already subscribed to the channel, feel free to do so to stay educated on the home buying process. But until next time, guys, buy right, borrow smart, build wealth. Adios.
Amigos.